Hello everyone. Our topic for today is Portfolio Management Services, commonly known as PMS. We have seen the power of equity and the astounding returns it generates over long periods in our earlier videos. We have seen that equities have historically outperformed all other asset classes in the long run, not just in India but also globally. We have also seen that equity is not risky in the long term. Yet we see our investors are not able to exploit equity's potential to the fullest. They may not be able to make great returns and might be settling down for average or below average returns. There may be cases when they are actually losing money in equity. So let's try to understand, why does this happen? Why don't people make the most of the best asset class? Why do they lose money in equities? The first problem is diversification. Either there is lack of diversification or sometimes there is over diversification. Many times you'll come across investors who have a portfolio of just 2 stocks, or the portfolio is concentrated towards one sector only. Out of a portfolio of 10 stocks, an investor has, let's say, Wipro, TCS, Infosys, Tech Mahindra, L&T, Infotech, HCL, and the rest 4 stocks belong to 2 different sectors. This investor might have made money in the past, but his future is at risk. What if the rupee gets stronger against the dollar? This will lead to a slump in the IT sector. Or for any other reason like fall in global demand, etc., the IT sector falls. This means the entire portfolio of our investor goes for a toss. There are also times when we come across investors who have a portfolio of 50 to 100 stocks. While under diversification increases the risk, over diversification is also not good. It may allow the entry of not so good stocks, thereby reducing the overall return of the portfolio. Another problem that is often witnessed is the investor may not have the best stocks in his portfolio. He might have sold the good quality stocks when the prices rose and booked profits thereon, and retained the poor quality stocks. So eventually, his portfolio is concentrated with a majority of non-performing stocks. The investor would have been better off with a professional helping him buy and sell the right stocks at the right time. The factors that lead to this chaos are tips, market timing, and emotion-driven investing. Talking about tips, these tips can be from friends and family, or from brokers, or even from newspapers or TV anchors. But even Warren Buffett, the god of investing, the most honored investor of the world, doesn't know what's going to happen next. Nobody has been able to predict the direction of the markets. Now, what the investor needs to understand is, if these friends or family, or the broker, or the news anchor knew which stock is going to rise or fall in the short term, these people would have been making money by investing themselves rather than giving away free advice. The second factor is market timing. The investors try to time the market and make their investment decisions accordingly. And in equity, it is important that the investor gives time to the investment rather than timing the market. And the third factor is emotion-driven investing. The investors make investing decisions largely on the basis of their instincts or gut feeling or fear, hope, faith, excitement, and plethora of other emotions like greed, envy, desire, rather than solid research or set guidelines. Now, these investors are human beings and emotions are an inseparable part of humans. And since these investors are attached to their money, so the role of emotions become manifold when the decision is about their money. These emotions not just led investors into taking wrong decisions, but also sometimes doesn't let them take decisions at all. For example, there's an investor, Om Prakash. Now, Om Prakash invested in ABC company's shares 6 months back. The current scenario is markets are doing great, most stocks are growing, and the indexes are surging. But somehow, our investors ABC is in the reverse gear. This is because there are structural challenges in the company. The debt-equity ratio isn't favorable, and there are internal disputes going on in the top management. So essentially, it was a bad decision since ABC was not the right pick. Which happens. Decisions can be wrong at times, and it's best that we concentrate on the solution. So ideally, the investor should wash away the dark spot. The solution is to get rid of the stock rather than losing more money in the future. But what our investor actually does is, he buys more shares of ABC because he is disheartened by the fact that his investment is into a loss. So, he plans to average out the cost by buying the same depressed stock, hoping that when it will rise in the future, he will sell all his shares and make an overall gain on the investment. So what has happened here is, because of his fear of losing and hope of gaining, the investor now has a big percentage of a lumpy stock in his portfolio, a decision which he might have to regret later. NJ offers a solution to all these problems of direct equity investing in the form of PMS. Although our primary product is mutual funds, yet we see that our partners come across many investors who do not want to take the mutual fund route for investing in equity because they want to experience the thrill of investing in shares and they want their portfolio to be concentrated into fewer stocks, unlike a mutual fund wherein the portfolio is diversified across a large number of stocks, like 50 to 100 stocks at times.